G'day folks, welcome to the weekly general update for the 9th and 10th of June. So just a quick reminder, general advice only in this information. So summary of the action for the week, the S&P had a big week. There was a large down day the previous Friday and then a huge bounce back early last week, and overall the S&P ended up 47 points on the week, which is one of the biggest up weeks in quite some time. It had been oversold, and we'll see that on the chart, so a rebound was very much on the cards, and I think the odds now favour perhaps pushing a little bit higher to maybe around the 1344 area. There should be some resistance, or again at 1363 if there is a bit more momentum in the US market. So they're the likely tops, and I believe from there we'll see some further downside, perhaps taking us down below the low of a week ago. But I don't expect the market to go there in a straight line, either up or down. I think we've got so many conflicting signals coming out of Europe, coming out of China, and to a degree coming out of the US that I think we're going to see these fairly volatile conditions persist for some time. And in actual fact, this kind of volatility is really the sort of action that you see around the time of a market top. There's a lot of nervousness, so it's another reason why I don't think we're going to see too much upside beyond 1363. The banking and small cap indices in the US also rebounded quite strongly, and one of the things that I've been saying for some time is that the strength of the small cap sector in the US is certainly not indicative of a major market decline. You would have expected to have seen a lot more money coming out of that sector at this stage, and we haven't seen that. So whilst I'm talking about more downside, and we could see some sharp individual day moves, I just don't think I'm seeing anything that suggests we're going to see a rerun of what we saw in 2010 and 2011. The VIX index is back down under 20 again, so fear has come right out of the market very, very sharply. Now, our market ended up flat on the week. It's really a timing difference between the US and our market, because some of these big moves, both up and down, have been on a Friday, and we see the result the following Monday. So we ended up flat on the week. And in Australia, there was some GDP numbers came out through the week that a lot of commentators have jumped on as a positive sign about how well we're doing, but frankly I reckon those numbers look rather suspect, and they need to be looked at in perspective. The consumer spending numbers were up considerably, and yet when you really look behind the numbers, that was really more about food purchases, and it really wasn't into discretionary items as well. And the fact that retail stocks and media stocks really didn't change much during the week. There was a one-day blip in the retail stocks to the upside, but the fact that they didn't respond, I think, is supportive of that. So you've probably got to look past some of the political rhetoric that's going on at the moment, with Swan jumping on the fact that our economy is doing so well. I don't believe that's the case, and I think that we'll see those GDP numbers revised down in subsequent quarters. The lower Australian dollar over the last couple of weeks, our dollar's come off from almost $1.10, we've got down to 97, is certainly making our stocks look more attractive to overseas investors. So let's have a look at those couple of charts. And we'll start first of all with the S&P index, and this all looks a little bit messy. I'll tidy it up in just a minute so we can get a better look at this, but you can see here we've got a 50% retracement level of the move that started in April, 2nd of April, and completed just a few days ago. A 50% retrace of that decline brings us back up to 1344. And if it managed to get up to the 61.8% level, then that's at 1363. So they're the areas that I'm looking at. 1363 also brings us up underneath these lows of the 10th of April. which would also make sense as well. So those two levels are the target areas. What I'm expecting, I believe we've seen a 5-wave pattern to the downside. This is leg 1, this is leg 2, this is leg 3, 4, and then 5. So there's a 5-leg decline, which supports my view that I think medium term we're now into a downtrend. So if we get 3 waves to the upside, and if we said that that was wave 1 to there, we may still get a little bit more downside, perhaps then some upside. So basically just some up and down action taking us up to perhaps that 1363 area, and I think that would probably finish that that counter trend direction, or that counter trend correction, and then I believe we'd be heading in a pattern to the downside, but nothing terribly dramatic, I don't believe. But we could go down and form new lows below 1260. So that's the S&P index. Let's have a look at the VXO. So the VXO, the fear index, we did get a pop up to 27 on Monday, but you can see it's come right back down again, and we finished around about the 20 mark by the end of the week. So it was certainly not indicative of a significant down move at this stage. Let's have a look at our local index, just for the heck of it, because to me it doesn't really mean a great deal, because it's just so dominated by just a handful of stocks. It's not really representative of what's going on in the market. But you can see, for the record, we basically have just been going up and down in a fairly concentrated range. So not as volatile here as we've seen in the US. Now let's just have a look at the US dollar index. We had 2 key resistance levels. The US index went through the first one at 81.5. It then went on to the second one at 83.5, which lines up with this high from back here in 2010. And we've seen a more significant rejection from that resistance. So at the moment it's really just in this range between it, 81.60 and about 83.30, 83.50. And I think where it goes in the near term is really going to be very much about political decisions coming out of Europe. So looking at bond yields, which are important for the overall direction of the market, the Spanish 10-year yield was down fairly sharply, because remember it was up to about 6.7 a week ago, dropped down to 6.21 in the previous week, so that's down quite sharply, which is a good sign. But when I prepared this slide, it looked likely they'll have to accept a bailout, and some recent news just through is, in fact, that would appear to be happening. They're not calling it a bailout because that's a bit embarrassing for the government, but I think the net result is pretty much the same sort of thing. The Italian 10-year yields didn't change much on the week. They're holding steady around about the 5.7 to 5.8 mark at this point in time. So bond yields in Europe have settled down, and hence why the US market has gone up a little. The US dollar we looked at, so we did get follow through to the downside, and it's just caught in between those 2 resistance levels and support levels at this stage. Now gold ended up falling $31 on the week. We had a huge rise the week before. We gave part of that gain back, probably about half of it, and we did see some fairly volatile action during the week. We had sharp falls on Thursday and Friday intraday before there was a strong recovery. So the gold price is pretty much being held hostage to all of the thought and sentiment and discussion around about QE3. Will it happen or won't it happen? And I think if and when, and I believe it's when, we'll see QE3 announced, you'll see a very significant surge in gold. Now both the key gold indices, the Huey and the GDX, were volatile during the week, but basically didn't do a great deal. They were pretty much unchanged, and so it's encouraging to see them holding those previous gains. Silver was flat on the week after a pretty strong breakout, and we'll have a look at that chart as well. Oil rose about $1 on the week, and it's not far off support for light sweet crude, around about $80, got down to about 82, so I'm not expecting much downside in oil from here. Copper finished down a fraction, down at $3.30, and is in short and medium term downtrend. There's the chart of copper on a 1 year basis. You can see that we had a lengthy period from February to mid-April where it was basically in a sideways range, and it started to come off since then. Nothing too dramatic at this stage. So let's have a look at some of the precious metals indices. So first of all, gold, and you can see here on Thursday we had quite a large move down, followed through on Friday, and it was down at 1560 at one stage, and then we had quite a solid turnaround in the US market before the session finished, so quite strong in the end. You can see here on the weekly chart we're still holding above this 1550 support, and the chart of silver somewhat similar. We had a I'll just tidy this up. I'm looking at potential resistance areas around 30.83 or perhaps just over the $32 mark. I'll just remove that little framework there. You can see we had quite a strong move on Wednesday night in silver. We got a breakout of this consolidation range, and then it abruptly turned around, gave back most of those gains on Thursday night, and then was similarly mixed on Friday night. The GDX, this is on a daily chart, so you can see for the week pretty much finished where it started, or where it closed the previous week. Closed 46.58 on the previous week and closed 46.33, so down just a fraction. And the Huey index, very similar, pretty much unchanged on the week. So just to wrap up, looking at overall strategy on the S&P, I think short term we should see a bit more bias to the upside. The S&P was quite oversold. In fact, let's just go back and have a look at the S&P for a minute. So the S&P, you can see here on the RSI, we formed a reversal pattern outside the Bollinger Bands, and the RSI was quite oversold. We then went on to form a lower low, but in fact the RSI was actually higher. So some good divergence there on the RSI was giving us a good indication that we would probably see a bounce in the S&P, and that's basically what I was saying last weekend, that to expect a bounce last week. Medium-term direction, however, I believe is down. So I would not be at all surprised over coming weeks or perhaps the next couple of months that we will see perhaps prices below $12.60. So looking at Aussie stocks, that means really your bias, I think, should be to the downside, if anything, looking to establish more short positions on a bounce in the market, which we'll probably see this week. Gold stocks have continued to make some good gains, which is great to see. There's been some outstanding gains. Silver Lake Resources has jumped 50% from its lows, and we're seeing some other gold stocks starting to rebound as well. Now, there's a few oil and gas stocks that are starting to look interesting, that are reasonably valued, but there's some that are still very, very expensive. They've got massive future premiums built in, and in a very nervous kind of market you can see those premiums come out fairly quickly. And of course, any small cap buying, I think the approach should be to take profits pretty readily and not have too much exposure for a lengthy period of time to small caps in this market. So that's it for this week. It'll be a really interesting week. We're going to have another US session before our market reopens again, and we've got a 4-day week ahead of us, so we'll see what that brings. Cheers for now.